Welcome to TalkTickers, your deep dive into the earnings calls shaping the market.
Glad to be here.
Today, we're unpacking a really interesting one, a recent Q2 2025 earnings call that, well, it definitely got people talking.
Oh, yeah. It's a fascinating situation.
Yeah.
You've got a company trying a major pivot right in the middle of some serious housing market headwinds.
Exactly. So we're going to break down their performance, this big strategic shift they announced, and try to figure out why the market reacted so, well, sharply.
It's a classic case of results versus outlook, I think.
Let's jump right in then. Q2 2025 numbers. What did they report?
Okay, so headline revenue was $1.57 billion.
And that was a beat, right? Against expectations.
It was, yeah, beat consensus. And it represented about a 3.7% increase year over year. So on the surface, pretty solid growth there.
But the profit picture was maybe a bit cloudier. What about EPS?
Right, so the official number, the GAAP EPS, that came in at negative 4 cents.
Okay. And the street was looking for?
Consensus was for negative 3 cents. So a slight miss on the bottom line, the GAAP bottom line anyway.
So revenue beat, slight GAAP EPS miss, but I heard there was something interesting with adjusted EBITDA.
Ah, yes. That's where things get interesting. Adjusted EBITDA actually came in positive, $23 million.
Positive 23. Wow. And that beat estimates too.
It did, yeah. Exceeded what the street was expecting. And, this is actually pretty significant because it's the first time they've posted positive adjusted EBITDA since, I believe, 2022.
So quite a turnaround on that metric. What does that signal, do you think, cost cutting paying off?
Definitely suggests some real cost discipline kicking in and maybe the beginnings of operational leverage, getting more efficient.
Okay, so revenue beat, positive adjusted EBITDA beat. Sounds like good news.
You'd think so.
But the market didn't quite see it that way after hours, did it?
Not at all. The reaction was pretty rough. The stock took a significant hit in after-hours trading.
Yeah, I saw it drop quite a bit, quite fast.
It really did. Seems like investors just zoomed right past the Q2 results.
And focused on what? The future.
Exactly. Focused on the forward guidance, which we'll get into, and just the general, macro worries hanging over the housing market.
So this gap between the reported quarter and the market's reaction, that's really what we need to unpack.
Precisely. It tells you a lot about market sentiment right now, especially for capital-heavy businesses. Yeah. Profitability and efficiency are paramount.
Okay, let's do that. Management spent a lot of time on the call talking about a big strategic shift, moving to an agent-distributed platform. Can you break that down for us? What does that actually mean?
Absolutely. So historically, this company was known for its direct cash offers, right? Mm-hmm. Buying homes straight from sellers.
Right, the iBuying model, basically.
Kinda, yeah. But that model, it eats up a ton of capital. You need cash to buy and hold all that inventory. Very risky when the market gets shaky.
Which it definitely is now.
Exactly. So this new agent-distributed platform is about shifting gears. Instead of being the main buyer, they want to, empower real estate agents, give them tools, products.
Partnering with them more.
Yes, turning agents into a channel, a source of deals, rather than just competitors or, the traditional route. They rolled out something called a key agent app nationwide.
Okay.
And they're piloting this new hybrid thing called Cash Plus.
Cash Plus? What's the idea behind that? How's it different?
Okay, so Cash Plus is, it's quite clever, actually. It lets homeowners get some cash out now using the company's balance sheet.
So immediate liquidity.
Right. But crucially, they still get to potentially benefit from selling the house on the open market later through an agent.
How does that work?
Well, the company gives the seller cash up front, handles the prep work for listing, and then partners with an agent to sell it. If it sells for more than the advance plus costs.
The seller gets the extra.
The seller can get additional proceeds, yeah. Mm-hmm. So they get speed and certainty plus potential upside.
And for the company, less risk.
Much less risk. They're not tying up as much capital holding the entire house. It's a better risk-adjusted approach. They still aim for a similar profit margin as their old cash offer.
But with less capital tied up and maybe a higher chance of hitting that margin target?
Exactly. It's more about leveraging their data and platform, less about just deploying their balance sheet. Capital efficiency is the name of the game.
That sounds, pretty smart given the environment. Are they seeing it work? What were the early results they shared?
They said the early tests were, quote, compelling. Some pilot programs showed, double the number of customers getting to a final cash offer.
Wow, 2 times. That's significant.
Yeah, suggests the funnel is working better. And even more striking, listing conversion rates apparently jumped 5-fold.
5 times. Okay, that's That's impressive.
It really is. It suggests this isn't just theory. It's, actually resonating with sellers and agents. They see it as a capital light way to generate revenue using their pricing tech.
And they mentioned agents already bring them deals sometimes.
Right. They said a good chunk of their acquisitions already came from agents bringing clients to them. So they're sort of building on an existing behavior, formalizing it.
Okay, so the strategy sounds promising. The early results look good.
Right.
But then we get to the guidance. And that's where the market seemed to hit the brakes hard. What did they forecast for Q3?
Yeah, this is where the optimism hits a wall. The Q3 guidance was, significantly lighter than expected. Revenue midpoint guided to $837.5 million.
And how does that compare to consensus?
That's about 29% below what analysts were expecting. A big miss.
29% below. Ouch. And adjusted EBITDA back into the red.
Yep. Projected between negative $28 million and negative $21 million for Q3.
And the full year?
Same range for adjusted EBITDA for the full year, negative $28 to negative $21 million. And revenue for the year guided to $875 million. They also flagged that Q4 revenue would likely decline sequentially at a similar percentage rate as Q3.
So the slowdown isn't just a Q3 blip. They expect it to continue through year-end.
That seems to be the message, yes. Near-term headwinds are expected to persist, even maybe accelerate slightly on a sequential basis.
What about margins, particularly contribution margin, which is key in this business?
They warned that contribution margin is going to be under pressure in the second half.
Why is that?
Primarily, they said, due to an unfavorable mix. They're cycling through older inventory, homes bought under perhaps different conditions or assumptions, and selling them into this tougher market.
So lower margins on those older homes are dragging down the average.
Essentially, yes.
Yeah.
And that pressure likely means their goal of improving contribution margin year over year for FY25 is probably out of reach now.
And any other cost factors?
They did mention Q4 operating expenses are expected to ramp up, mostly due to higher marketing spend.
Marketing. Why ramp that up if the market's tough?
Planning ahead. They want to acquire homes before the typical spring selling season kicks off next year. So investing now for future volume.
Got it. Strategic spending, but it hits near-term profit. Okay, so we have the strategy, the near-term financial pain. But can they actually afford this transition? What does the balance sheet look like? Do they have the runway?
That's always the crucial question, isn't it? Well, they ended Q2 with $789 million in unrestricted cash.
Okay, that's a decent cushion.
It is. Inventory stood at $1.5 billion, which is about 4,500 homes. That needs careful management, obviously.
Sure.
But they also did some smart financial maneuvering back in May. They issued $325 million in convertible notes due way out in 2030.
Convertible notes? Debt that can become stock later.
Right. And doing that let them push out maturities on older debt, giving them breathing room, and it added about $75 million in fresh cash to the balance sheet.
Smart moves, extending the runway.
Exactly. And one other important point, they recently got back into compliance with NASDAQ's minimum bid price rule.
So the stock price is consistently above $1 again. Why does that matter?
It removes a key overhang. Some institutional investors have rules against holding stocks that aren't compliant, so regaining compliance can broaden their potential investor base. It's a technical thing, but important.
So financially, they seem to be shoring things up, but they can't control the overall market, can they? What are the big macro factors really dictating their outlook?
Yeah, the macro environment is just brutal for housing right now. The biggest factor is mortgage rates. Persistently high, often bouncing around 7% or more.
Which just kills affordability.
Completely. It's sidelined a huge number of potential buyers. And that slowdown in demand leads to knock-on effects. They mentioned seeing record delistings.
Sellers pulling homes off the market.
Yep. Rather than sell low, they just wait. And also wider offer spreads, bigger gaps between what buyers will pay and sellers want. Makes deals harder to close.
Did management see any signs of things getting better?
They said the deterioration they saw through Q2 has sort of stabilized now. But, and then this is key, their Q3 and Q4 guidance assumes this current sluggish environment just continues.
No improvement baked in.
No improvement. They explicitly said they don't expect any pickup in seller demand near term. They also noted how short the period of positive home price appreciation was this year compared to usual. Fragile market.
Okay. So putting it all together for someone listening, what's the takeaway? You've got this really interesting, maybe even necessary strategic pivot.
Right. The agent platform, the capital light model.
With some promising early signs. but slammed up against this wall of high rates and slow demand, leading to pretty bleak near-term guidance.
That sums it up perfectly. It's like they're building a potentially faster car, but they're trying to drive it uphill in a blizzard right now.
So the big question becomes, can that new engine, that agent strategy, get up to speed fast enough? Can it scale quickly enough to actually counteract the drag from the weak market and the declining older business model?
That's the billion-dollar question, isn't it?
Yeah.
And management themselves kind of tempered expectations there. They said the full impact of this platform shift on the P&L on the actual financial results.
Won't really show up until when?
Not expected until 2026. There's just a natural lag between signing up partners or closing these new types of deals and actually recognizing the revenue and profit.
So patience is required. Meanwhile, the stock itself has been on a tear recently, right? Before this post-earnings drop.
Absolutely. The wild ride. The returns over the last, say, 1 to 3 months were huge, like up hundreds of percent, massively outperformed the broader real estate ETFs.
So some real momentum trading or maybe excitement about the potential.
Probably a mix of things. Broader market trends might have helped too, but
that sharp sell-off after the call tells a different story.
it screams skepticism about the near term. Despite the positive spin on the platform, the market heard the weak guidance and the margin pressure loud and clear.
So what's the long-term target here? What are they aiming for by 2026?
Their stated goal is profitable, capital-light lead monetization by 2026. Basically proving they can make money from connecting buyers and sellers using their tech and agent partners without having to own every single house.
If they pull that off,
It could fundamentally change how the market values the company. Move it beyond just being tied to housing inventory cycles.
so what should people watch for? Key catalysts.
Definitely the next earnings report, Q3 results, probably early November. See if that guidance was too conservative or spot on. Watch the full rollout of Cash Plus as it expanding. And of course, any major shift from the Fed on interest rates, that could change the whole macro picture overnight.
Okay, now as we always do, let's pivot to our not financial advice segment. This is purely for informational and entertainment purposes, folks, not recommendations.
Absolutely not financial advice, just some thought experiments.
Given everything we've discussed, the pivot, the headwinds, the volatility, what are some, let's say, outrageous but plausible ways someone might think about this situation from a trading perspective?
Okay, playing devil's advocate here. Here are a couple of angles, again, purely speculative. Idea one, the long game with leverage. If you're a true believer in this agent-driven capital-light future and you buy into that 2026 target.
You think the current pain is temporary?
Right. You could consider building a long position, but maybe carefully, in stages. Use any further dips caused by bad housing news to buy incrementally.
Okay, accumulating on weakness. What's the outrageous part?
Pair that core stock position with some long-dated, out-of-the-money call options, maybe 12, 18 months out.
So options that are currently cheap but could pay off big if the stock really takes off?
Exactly. It's a leverage bet that the strategic pivot will eventually work and lead to that re-rating we talked about. You risk less capital upfront on the options compared to just buying more stock, but capture potentially large upside if you're right long-term.
Betting on the transformation succeeding. Okay, what's the flip side?
Idea two, the near-term skeptic. If you look at the Q3 guidance, the margin pressure, the macro headwinds.
And you think things get worse before they get better?
Precisely. If you're skeptical they can navigate the next few quarters smoothly, you might consider a short position or maybe buying put options.
Betting on the stock price going down.
Right. Maybe shorter term options like 3 to 6 months out, align with that Q3, Q4 guidance period where they themselves are forecasting declines and pressure.
And the plausible part of that.
The plausibility comes directly from management's own cautious outlook. They're guiding for sequential revenue drops and squeezed margins. You'd essentially be betting that the market continues to focus on that near-term reality and the 2026 story isn't enough to prop up the stock yet.
Betting that the macro and the time lag win out in the short term.
Exactly. Two very different ways to look at the same complex situation.
Fascinating. Okay, let's wrap this up. Today, we really dug into a company caught between a bold new vision and some harsh market realities.
We saw decent Q2 numbers, that surprising positive adjusted EBITDA.
But a market reaction driven entirely by cautious guidance and worries about the housing market slowdown.
Yeah, a real disconnect. It highlights that tension between long-term strategy and immediate financial performance.
And ultimately, it seems the jury is still out. Can this pivot to an agent-focused, less capital-intensive model actually scale fast enough to navigate these headwinds and create real sustainable value?
That's the core question. Will the strategy outrun the macro storm, or will the storm stall the strategy before it gets traction? Only time and maybe the next few earnings calls will tell.
Well, thank you for joining us for this deep dive. Remember, everything we discussed is for educational purposes. It's definitely not financial advice.
This is your own research.
We hope these insights give you food for thought and maybe help you ask better questions as you follow this story. Until next time, stay well informed.